Hey, what's up guys? Welcome back to the channel. In this video, I'm going to be continuing my cryptocurrency retirement series. I'm going to be talking about how you can take advantage of retirement vehicles like IRAs or 401ks so you can invest in cryptocurrencies now, especially now that we're in a bear market, so that once cryptocurrencies reaches valuations such as companies like Google, Amazon, or Facebook, you can cash out these cryptocurrencies without having to pay a single dime in taxes. But you might be asking yourself, which is better? Should I put all my efforts in an IRA or should I put it all in a 401k? Well, this question is a little bit complicated, but I will dive into all the details and differences in this video. But before we get started, this video took hours and hours to make, so I will really appreciate it if you guys give this video a thumbs up below. Also, subscribe to my channel if you want to follow my journey to financial independence. Okay, we first have to know all of our options when it comes to retirement vehicles. The four well-known options in no particular order are the Roth IRA, the traditional IRA, the Roth 401k, and the traditional 401k, also known as the pre-tax 401k. So you probably noticed that all four options have a common denominator, which is deciding between a traditional or a Roth option. Let's go ahead and discuss the differences. The biggest reason why someone would choose to invest in a traditional IRA or a traditional 401k would be to take advantage of tax breaks. With a traditional IRA or a traditional 401k, you are investing pre-tax money. Let us take an example of someone that is making $100,000 per year. In 2022, if you are under the age of 50, you are able to contribute up to $6,000 in a traditional IRA or up to $20,500 in a traditional 401k. This number for the 401k will slowly increase each year as you factor in inflation. If you're over the age of 50, you're able to contribute up to $7,000 in a traditional IRA versus $27,000 in a traditional 401k. So you can clearly see that no matter if you're over 50 or under 50, a 401k is definitely better if you want to contribute more money towards your retirement. The more money you contribute, the less you have to pay in taxes because it essentially reduces your pre-tax income. Looking at our $100,000 salary example, if you contributed $0 to your retirement account, then you will be taxed based on $100,000. Versus, let's say you're over 50 and you decided to max out your 401k and you contributed $27,000, then you essentially reduced your $100,000 income by $27,000. And if we want to quantify the tax savings of this, let's just use a pretty aggressive tax rate of 30%. In our $100,000 salary example, if you contributed $0 to your retirement account, then with a 30% tax rate, then you will essentially pay $30,000 towards your taxes. If you're over the age of 50, for example, and you max out your 401k and you contributed $27,000, then your taxes will be reduced to only $21,900 versus the $30,000. This will be a tax savings of $8,100 because you decided to take advantage of traditional retirement methods. So clearly, if your goal is to reduce your current taxable income, then a traditional 401k might be the option for you. Now let's talk about my personal preference. For example, for me, I prefer a Roth option, either a Roth 401k or a Roth IRA. With our example of the person making $100,000 and contributed $27,000 in his or her retirement account, he or she is able to save $8,100 on taxes. The biggest caveat with this is this person is only deferring taxes for the future, meaning this person still has to pay it in the future once he or she liquidates their portfolio. Let's assume that this person invested this $27,000 in an asset that yields 10% ROI year after year for 20 years and no additional contributions. At the end of 20 years, this person will have a portfolio that is valued at $182,000. Let's assume a conservative tax rate of 20%. If this person were to liquidate their entire portfolio, then they would have to pay $31,000 in taxes. We have one more final piece to this comparison, as we are obviously not comparing apples to apples. In our example, we are considering saving $8,100 in today's money versus saving $31,000 20 years later. Let's do some math real quick. The US dollar has an average inflation rate of 2.5% per year over the last few decades. We're currently in a high interest rate environment, so let's just be aggressive and double that to 5%. With that said, $8,100 in savings today, given a USD inflation rate of 5% per year. Fast forward 20 years later, this will be roughly $21,000 in value 20 years later. So with our calculations, we still come out ahead, and we are essentially saving $10,000 by going with the ROTH option. This example only also considered a one-time contribution of $27,000 that first year. If you maxed out this contribution year after year, then you would have even more in tax savings. So now you see why investing in a Roth retirement vehicle is my go-to option. With a Roth IRA or a Roth 401k, you're paying taxes on your salary now in order to avoid paying taxes on your portfolio once that portfolio grows multiple fold in the future. There were also other variables that I didn't consider in this video. What if you contributed more than $27,000 using a backdoor strategy? This topic is a little bit more complex, so I will discuss this in a separate video. Also, what if you're a little bit more of a sophisticated crypto investor, and again, this is only an assumption. What if you're able to generate 3% on a staking pool like Cardano or Ethereum over that 20-year time span, plus an average return of 10% per year? Then you're essentially generating 13% per year. And if you decided to go with a Roth option, this 13% year-over-year portfolio growth, you will be able to prevent paying taxes on that portfolio gains. We already saw a great example. Amazon, coming out of the dot-com bubble, was able to generate an average yield of 15% year after year over the next coming decade. So if this was possible for Amazon, obviously you have to pick the right crypto option. This would essentially be possible for other cryptocurrencies like Cardano, Ethereum. Again, you have to pick the right vehicle. So with all of that said, all of these factors strengthen why I prefer a Roth option versus a traditional option. Now that you know that I prefer a Roth option, let's compare the differences between a Roth IRA and a Roth 401k. Right off the bat, the biggest reason why someone would choose a 401k option is they may have an employer that offers a 401k match. A lot of employers nowadays have the option where they match 100% of your contributions up to 6% of your salary. So using our example, someone that makes $100,000 in salary with a 100% employer match up to 6%, this person would be receiving a $6,000 employer match, essentially what they call free money. The biggest downfall in a Roth 401k account is that you're not able to use it as a short-term savings account similar to a Roth IRA. As I mentioned in my last video, you're able to use a Roth IRA as a savings account as you're able to withdraw your original contributions tax-free and penalty-free. If you want to know more about a Roth IRA, then I will post a link down below from my last video where I already talked in detail about a Roth IRA. With a Roth 401k, any withdrawals or distributions you make on that portfolio, if you're under the age of 59 and a half, will be subjected to 10% penalty plus any taxes depending on your tax bracket. So with that said, let's quickly go over the rules for withdrawing your Roth 401k funds without having to pay the 10% penalty plus the tax. So number one rule, as I mentioned above, you have to be the age of 59 and a half. The second rule you have to follow is that you have to have that account open for at least 5 years. The IRS does allow you to take certain distributions from your 401k if you meet certain conditions, such as for medical bills, education, disability, but you start to lose the benefits of a Roth 401k in the first place. Plus, even though you're not subjected to the 10% penalty for meeting these certain conditions, you're still subject to paying taxes depending on your portfolio gains in that 401k. As you can see, if you're someone watching this video that may not have that much in disposable income, and you might need this money in the near future for certain expenses that might come up, then you might consider a Roth IRA, given the fact that you're able to use this as a savings account. Again, there are a lot of complications and many variables that come into play when making this decision, so definitely talk to your financial advisor before making your decision final. So if you're watching this and you're the type of person that is able to contribute more than $6,000 per year towards your retirement account, then my go-to option, if that was me, is to max out the Roth IRA first, buying crypto there, and then next would be to max out the Roth 401k, again, where you're able to also buy crypto using that account. If you're watching this and are considering opening a Roth IRA account where you're able to buy crypto, then my go-to option would be iTrustCapital. They are a Roth IRA platform that uses Coinbase custody to hold our assets. You can watch more about this from my last video, How to Avoid Taxes Legally, Roth IRA Explained. Again, I will leave a link down below. Also, if you decide to go with iTrustCapital, I will appreciate it if you use my link down below in the description. It does help the growth of my channel. So if you're watching this video and you're able to max out a Roth IRA using iTrustCapital, for example, or self-directed if you want, and you're asking yourself, hey, I'm able to contribute more than $6,000, now I have the option of deciding, is it better to contribute using a self-directed 401k option, again, a Roth 401k, or is it better to contribute directly to the workplace where they're able to match 100% of your contributions up to 6%? Well, no worries, let's go ahead and talk about that and jump into our final case study. Really, the main question we have to ask ourselves is that can we beat an employer match by investing in cryptocurrencies in a self-directed 401k? At this point in time, even hearing the news of Fidelity offering Bitcoin in their 401ks and pension plans, at this point, not many employers are on board with this, given the potential risk. So as you're watching this video today, there's really not many employers that really offer buying cryptocurrencies using your employer 401k account. So the only option we have today, if you do want to buy cryptocurrencies in your retirement accounts, is a self-directed option. So now let's compare the differences between the two. So the first example, you just invest in a 401k using your employer. You take advantage of the 401k match, but you're stuck with investing in things such as stocks or bonds or mutual funds, things like that. And most likely you're not even able to pick your stocks. Most 401k options nowadays, you're only able to pick things like mutual funds or an index, for example. So you're not even able to pick a specific stock. If that were the case, I would have probably invested in something like a MicroStrategy if I wanted Bitcoin exposure. So the second example that we're gonna look at is someone that is self-directing their 401k, but they're able to invest in cryptocurrencies. Which portfolio will provide more financial gain in the future when comparing the two? Let's go back to our old example of that same person making $100,000 per year with a steady increase of 5% per year in annual salary. Again, we're gonna apply this for both the 401k employer option and then the self-directed 401k option. That person who takes advantage of the employer match, again, the 100% employer match up to 6% of his or her salary, assuming an average rate of return for that person of 10%, that person would have a portfolio after 20 years valued at $1.338 million. Now let's take another example of someone that decides not to take advantage of the employer match and instead uses a self-directed option, but they're able to buy cryptocurrencies. That cryptocurrency investor who decided to self-direct their 401k instead of taking advantage of the 401k match from the employer, this person would have a portfolio valued at $1,140,000 $1,440,000, so $1,440,000 over the 20-year time span. This is a difference of $100,000. Again, this example only assumes that this person only makes 15% per year per annum over the 20-year time span. If this person is able to generate more yield, then obviously the differences would be much more significant. In summary, if you're a person that does not have much in disposable income, then you might want to consider investing in a Roth IRA, especially given the fact that you're able to withdraw your original contributions without having to pay 10% penalties or taxes. Again, consult your financial advisor. If you're pretty well off and have a pretty decent salary and you're able to max out your Roth IRA, then you might want to consider investing in a self-directed Roth 401k, where you can buy any cryptocurrencies that you want, Bitcoin if you're pretty blue chip, Ethereum, Cardano, or even small cap tokens. Because if you self-direct your Roth 401k, then you can essentially buy any cryptocurrencies that they offer at exchanges or a Uniswap, for example. And the biggest advantage of self-directing is that you're able to put your cryptocurrency assets in a cold storage wallet. Again, if you're watching this and don't currently have a cold storage wallet, then I will definitely appreciate it if you guys use my link down below. It does help the growth of my channel. I hope you learned a lot about retirement accounts after watching this video. If you have any questions after watching this video, again, this video is a little bit complicated with all the retirement account options that you have out there. Definitely write me in the comment section below. If you have not already, definitely subscribe to my video down below if you want to follow my journey as I try to achieve financial independence. God bless you all, and I will see you in the next one.